problem is this, the banks. And look at an ETF like KBE, which is the major bank ETF. Look at Bank of America. Look at Citicorp. I mean, these banks are dropping enormously, far more than the S&P. So right now, I'd say we see this pullback in gold and silver as a major buying opportunity. We're looking for the least excuse to define the upturn. And I strongly suspect it won't really take a full 30% crash in the stock market to do that. I think you got to watch the banking sector. If it doesn't behave well real soon, and already it's done so much damage, I don't think it will, the Fed will panic. And that's the name of the game.
In recent weeks, the financial markets have been rattled, not just by economic data, but by political moves with far-reaching consequences. U.S. President Donald Trump's latest push for sweeping tariffs has sent shockwaves through investor sentiment, stoking fears of renewed trade wars, inflationary pressure, and strained global supply chains. While mainstream media zeroed in on surface-level analysis, headlines focused on political tension and consumer prices, a deeper, more systemic shift was already underway. Beneath the noise, the stock market showed signs of real fragility. The banking sector, in particular, began to slide more aggressively than the broader market, exposing cracks that have long been forming beneath years of artificially low interest rates and easy money policies. To seasoned market technician Michael Oliver, this moment isn't just a temporary stumble, it's the next stage in a much larger unwinding. According to Oliver, the 15-year run-up in stocks, fueled by relentless quantitative easing and suppressed borrowing costs, ended earlier this year. What we're seeing now, he argues, is not just a correction, but the beginning of a structural decline, one that will have profound consequences for banks, the Fed, and ultimately, for the value of the US dollar. But there's another side to this story, and it's one that most investors continue to overlook. While the stock market weakens, gold and silver may be gearing up for their next major move. Contrary to popular belief, precious metals don't simply mirror the stock market. They respond to the long-term decay in the value of fiat currencies and to the policy responses that follow financial instability. As Michael Oliver explains, history shows that when confidence in the system falters, gold and silver don't just preserve wealth, they often surge. As we present clips from his latest interview with Liberty and Finance, please watch, share, and like this video, subscribe to the channel, and turn on the notifications post for more videos like this. We appreciate the support and hope you enjoy the video.
We've been waiting for the stock market to top because the technicals have told us this is the biggest bubble in stock market history that ended early this year. From 2009 to then, 15 years of massive multiple upside caused by monetary policies. We know QEs lasted for, we had free money for 10 or 15 years. And even when they raised rates, it was lower than it had been in 50 years. So, it was free money. Okay. When you have free money, it goes somewhere. And it went into the stock market. Investors now are deciding maybe they don't want it there. Okay. And yes, the guys who claim, and there's many of them, and analysts and investors, that when the stock market goes down, so does gold. They're too much focused on a narrow event in a brief period of time. The last time of where this occurred, and they still remember it, is that October of 2008. At that point in time, gold had already been rising since its lows in price. In the year 2000, 2001, it was about $260. It went up all the way to 1,000, okay, quadrupled. And that was before that collapse in the stock market. And in fact, part of that was while the stock market had already topped and was headed down. The stock market had been dropping for a full year, and gold still rising. But in the summer, especially in October of 2008, the stock market finally had a sharp drop within the context of what was already an ongoing bear market. It dropped like 30% in a month, okay, October of 2008, a year off the high. At that point, gold said, I'm going to correct too. I'll use this as a correction opportunity. And it had a collapse down into the 600s. And people think it goes with the stock market. Gold is a monetary metal. It is the inversion of the ongoing collapse in the real value of paper money units, yens, euros, dollars, you name it. They always depreciate because governments always expand the money supply. They create free money, artificially low price of credit, and it creates distortions. And gold is merely an ongoing reflection of the decay in the monetary units that we use. That's still going on now. Money supply is still growing. It basically doubles almost every decade. And when the Fed has an excuse or justification, which is what they were created for, to save certain institutions, banks especially, they push the pedal to the floor. Okay, and sometimes they back off a little bit, but then they push it to the floor again. If you saw Powell today, he was comfortably smiling and talking about, well, we have these two mandates and the economy looks solid. Even the reporters in the audience were smart enough to say, yeah, but when the stock market goes down, then the data points change. It's a point we've been making for many months. They don't turn first and then, the economy's getting worse, so the stock market goes down. No, the Fed is going to have soon all the data points they need to smack them in the face to, again, push the pedal to the floor. And I know they don't want to because, frankly, they don't like Trump. He doesn't like them. So there's an antagonism there. And so Powell's kind of smiling right now because stock market's going down and he's not getting blamed for it by keeping rates too high for too long. Trump is getting blamed for it. So he's in perfect position. The problem is this, the banks. And look at an ETF like KBE, which is the major bank ETF. Look at Bank of America. Look at Citicorp. I mean, these banks are dropping enormously, far more than the S&P. In fact, over the last week, S&P be down 3 or 4% one day, 3 or 4 the next. Banks would be down 6 or 8%, 10%, et cetera. And I'm not just talking one or two, but the sector. Okay, that is a sector that few people are talking about for some reason. And that's the one that will provoke the Fed into panic mode and probably not even waiting for a meeting. So I think that's where we stand right now. And I think that is an underlying explosive ingredient for gold and for silver.
As Michael just explained, the current market downturn isn't happening in a vacuum. It's the result of years of easy money policy, aggressive monetary distortion, and now renewed political shockwaves like Trump's sweeping tariffs. The banking sector is already flashing warning signs, falling faster and harder than the broader indices, and few are paying attention to just how dangerous that is. But what makes this moment especially critical is the Fed's position. With inflation still lingering and rates already high, policymakers are running out of room to maneuver. Yet, as history shows, when stress in the banking system reaches a certain threshold, the Fed doesn't hesitate. It slams the accelerator, floods the system with liquidity, and in doing so, further erodes the real value of paper money. This is exactly where gold and silver step in, not as speculative assets, but as barometers of monetary decay. As fear returns to the market and confidence in fiat currencies weakens, precious metals often become the destination for capital-seeking stability and truth. In the next part of Michael's analysis, he digs deeper into the connection between gold and the stock market, particularly how the decline could trigger a fresh round of panic at the Fed, and how this could ignite the next leg up for gold and silver. Stay with us.
If you look at the mama market, gold, right now as we speak, it's trading 3.5%, okay, off of its high daily close, which occurred a week ago. But it's down 3.5%, okay. Stock market was, look at, bank sector, stock market, and silver and commodities also going down because, we're going into a depression or something. Well, we might be, frankly. But there's a couple mistakes there. One is the assumption gold goes down with the stock market. Yeah, it could go down on a couple weeks here and there with the stock market in a sharp situation. But let's go back and look, for example, at that October of 2008 event. That's when the stock market had already been coming down hard for a full year and finally had a puke. Okay, and gold said, I need to correct anyway, so it had a puke. The Fed sat and watched the banking sector implode during the summer. I mean, Lehman Brothers went under in September of 2008. Stock market collapsed the next month in October. And it wasn't until November that the Fed finally said, okay, we got to do something. But they'd been cutting rates all the way down, but they did QE at that point. So right after that October collapse, a full month or two after Lehman went under, the Fed finally woke up, copied the Japanese model, and started doing QEs. November 2008. Stock market, by the way, went down for 5 more months into March of 2009, substantially further lower. But if you bought early in November, right after that October debacle, where you thought, oh, stock's going down, therefore gold goes down, actually, gold stopped and turned and started to explode back to its highs within about 3 or 4 months, had gained from the 600s back to 1,000, like a 50% gain. Not because the stock market turned up, no, because the Fed hit the pedal. And that's what causes gold to move the way it does. Now, right now, if you look at Powell today, they're not going to hit the pedal. He's just going to be academic about it and wait for the data points. I mean, when the blood's in the street, he'll finally see the data points. I strongly suspect that the phone calls between the major banks and the Fed have been increasing at a tremendous rate over the last week or so. Because it's not just one bank, it's all of them. They're going down much harder than the stock market. So everybody's talking about, oh, well, Tesla collapsed and Nvidia's down hard. Who cares? It's the banks that matter to the Fed. After all, the Fed is the banks, okay? Now, that's why gold's down 3.5%. Somebody's buying gold relative to the rest of the world. And I think that's because they see what's coming. The Fed has maybe learned a lesson since 2008 and learned, hey, we can't wait too long. We can't wait for an actual big bank to go under because then we'll look like idiots. We need to actually do a QE, start buying assets, start buying banking ETFs or whatever, bank stocks or commercial real estate's another implosion area, before it becomes a bloody headline. And I think gold knows that. It knows maybe the Fed's a little smarter now and will implement their aggressive policies real soon. Watch the bank sector. That's the key. Now, the case is silver. Investors are making a big mistake there. Okay, if we're going into a major global recession, maybe a depression, wouldn't surprise me, given the bubble size of the U.S. stock market, the Japanese market, and the Indian market. They're all imploding together. Industrial commodities will go down. Now, they don't necessarily have to stay down because when the Fed puts the pedal to the floor again, that money goes somewhere and commodities are still dirt cheap and we think they're going to go up. But right now they're going down with the stock market. Industrial commodities, crude oil, copper. Okay, they're treating silver not like gold. Like I said, down 3%. Silver's dropped from $35 to $29 almost in a matter of a week or so. It's behaving like copper and oil. Somebody's making the conceptual error that silver's an industrial commodity, not a monetary metal. So just fundamentally, now there's technical reasons for what I'm saying. Just fundamentally, if I were an investor wanting to put my money in monetary metals, knowing that the Fed's going to panic here, probably sooner than they did in 2008, that I want to own monetary metals because paper money is going to be far worth less than it might otherwise be because they'll accelerate the growth in the money supply. I'd look around and I'd say, well, gold's behaving well. Yeah, I'd want to be in gold, but that silver's ridiculous. It's a slingshot situation. It is not copper. It is not crude oil. Okay? It's a monetary metal. And right now, for the last week, investors have forgotten that. And they often make mistakes. Investment crowd often makes excessive mistakes either way. So right now, I'd say we see this pullback in gold and silver as a major buying opportunity. We're looking for the least excuse to define the upturn. And I strongly suspect it won't really take a full 30% crash in the stock market to do that. I think you got to watch the banking sector. If it doesn't behave well real soon, and already it's done so much damage, I don't think it will, the Fed will panic. And that's the name of the game.
Gold may be down 3.5% from its recent highs, but history reminds us that temporary pullbacks are often the calm before the monetary storm. Just like in 2008, once the Fed hits the panic button, whether through QE or renewed asset purchases, gold has a track record of snapping back hard and fast. It's not about reacting to the stock market. It's about responding to the policy pivots that follow financial cracks. Silver, on the other hand, is being misunderstood. Investors are treating it like an industrial metal, lumping it in with copper and oil. But silver isn't just a commodity, it's a monetary metal, and right now, it's priced like the market forgot that. That disconnect, it's not just a misstep, it's an opportunity. Michael calls it a slingshot situation, the kind of setup that happens when fear drives irrational decisions and fundamentals take a back seat. But once the Fed blinks, and it will, we're likely to see a swift revaluation of both gold and silver, especially as fiat currencies lose more of their value in the next round of monetary expansion. So whether you're a seasoned investor or just waking up to the bigger picture, keep your eye on the banks, watch the Fed's body language, and remember, when paper starts to burn, gold and silver don't just survive, they thrive. Do you agree with Michael Oliver's analysis of the banking sector and the gold and silver market? Let us know your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on the notifications bell for instant alerts. Thanks for watching, and see you in the next one.